Hi, this is Lucas with Wise Beyond Bitcoin,
And this is Ryan from Wise Beyond Bitcoin.
and we've got some breaking news to share with you today, some exciting research. We're very happy to share this good news about blockchain, crypto, digital assets, and of course, many people are familiar that Gary Gensler with the U.S. Security Exchange Commission, SEC, there has been a lot of talk over what is a security? Is Ethereum a security? Are digital assets a security? And should digital assets, blockchain, this new technology, be lumped into the original paradigm of securities? And there are lawsuits from the Attorney General of New York going after institutions as well as the SEC themselves, claiming that they're engaged, these intermediaries are engaged in the selling of securities, and that all blockchain projects or most blockchain projects are securities. So the good news is we've got some great research to share with you to show that as a matter of fact and economic reality, that blockchain digital assets fail the securities Howey test on all 3 points, and we'll break down each one for you. Of course, our background, how we met, and why we love to share this information. We've had this channel to talk about blockchain, crypto, and economics for some time. A specialty is not pumping projects. We aren't sponsored by any blockchain. We are very interested in just this new technology as it emerges and changes the economy at large. Our background specifically is in money and banking and economics, where we met over a decade ago. So it's been very exciting for us to cover the development of cryptocurrency, as it's called. And we'll get into that later, but blockchain and how it fits into the future digital economy. And of course, the point today is spread the good news, share the good news with, we want to get this out to other crypto. There are some great educators out there in the world of blockchain and crypto, but to lawmakers, to politicians, and to people who wish to just be engaged in the process of helping decide the direction that we take with these tools in the new economy. Okay, that was long-winded, but that's who it's
Well,
for.
that's a good introduction to what we're actually doing today with this video. So the SEC has a whole bunch of guidance. They have a paper on their website. It tells exactly what's involved in deciding whether or not a thing is a security or not. So this is the so-called Howey test. And there's really three main kind of considerations, right, that they're looking at. And we're going to walk through them, talk about why crypto, digital assets, whatever you want to call it, why they don't meet these three standards that something has to meet for it to be a security. So let's just walk off. Let's start off and get going here.
And
so the first,
I'm
go
gonna
ahead.
say one more thing real quick. Our goal,
Yeah,
like you were just talking about, our goal is to promote education and in support of
right.
blockchain development and for technological process and for healthy regulation. So it's to
Right.
promote a better understanding. It's not to push opinions on any project or for any bias. Our goal is to be as scientific from an economics perspective as possible, and to share that understanding from more of an education teaching perspective, because as we go through, that's why we're using the SEC's website, we're using their definitions, and we're going to go into case study, college law review, and getting a better understanding of the Howey test in traditional markets, as well as explaining how blockchain and crypto works. And hopefully with that understanding, people can make up their own minds and own decisions as to whether or not the SEC's Howey test fits blockchain and crypto, and whether that's relevant, or whether it seems like trying to have the horse and buggy industry be in charge of regulating and determining the future of the automobile
Right.
industry. So, okay,
Yes. So
now
it's
that I
it's
added
all
that,
about getting a better perspective, right? Adding some context and letting people make their own minds up instead of us trying to, you know, tell you that our opinion is the truth, right? Because we're going to shine light on some of these things, but there's things we don't get and we don't understand that's beyond us. So it'll be a group effort, but hopefully the outcome will be more light than heat, right? So let's start at the beginning, because one of the what kind of got this train of thought rolling for us was we took a look at the first main criteria that something has to be considered to be a security, and this is where our focus was drawn, because it just jumped out as being, you know, kind of a stretch, right? So the first criteria is that there has to be an investment of money. The very first prong of this test, this Howey test, is that in order for an asset to be considered to be a security, there has to be an investment of money, an investment contract in money terms. That's the very first thing. Now, when you're looking at the SEC's guidance, they have a little subscript under the investment of money paragraph, and it says 9. So subscript 9 deals with how or why and kind of the details with what's being said. And the main point in this subscript is that it says that the lack of monetary consideration for digital assets does not mean that the investment of money is not satisfied. So the point there is that if you didn't purchase these digital assets, but say you received them as an airdrop or as a bounty program or something, they're gonna still consider that to be an example of an investment contract with money, in money terms, right? So they're just making that as, you know, we're going to consider it as that's how it's going to be considered, right? Now the question here we have is that how accurate is it, or how accurate is it to call cryptocurrency money, and is it money? What's involved in this, right? And I mean, we can, you know, speak up whenever you have a thought, but I'll just start off on kind of the first thing is there, you know, money is not just some arbitrary thing that you can just make it, you know, whatever you want money. You know, we have people trading all kinds of things. People trade art and all cars, but those things, just because something has this value, this exchange value, it doesn't necessarily make it money. And in fact, there are properties that something has to be for it to generally be considered money in economic theory.
I'll step in real quick.
Yeah, jump on in.
Just to mention, when it comes to digital assets, because that's what we're talking about, blockchain and crypto, it easily doesn't pass the money test, because as even politicians and lawmakers, it's been declared throughout the beginning of Bitcoin that Bitcoin is way too volatile to be money. Everyone has always known that cryptocurrency, digital assets, Bitcoin, which is the most stable of all of them, is way too volatile to be a money. So the idea that all of a sudden during Gary Gensler's tenure at SEC, that digital assets just get to be called money all of a sudden to conveniently fit this narrative, it doesn't hold weight when you look at the standard of money throughout time. And, you know, obviously our economics background is at U of H, not at MIT, but I'm sure that many people at MIT would probably be saying, hey, Gary Gensler doesn't speak for us on this, because, you know, economics 101, when it comes to what is money, you've got unit of account, medium of exchange, and store of value. And it's been critiqued for a very long time that digital assets, they just can't be a store of value, because 1 minute they're at this price, the next minute they're that price. And while they can be divisible from a unit account, they're actually not a medium of exchange. You can't go around the world. Things aren't priced as a unit of account. You don't go buy a sweater or go buy groceries in Ethereum or in Satoshis. So really, the only metric that Gary Gensler is using is that you have something that has some value at a point in time, and because you are given something that some people value, I'm going to call it money for this case. But
yeah,
in reality,
and to your point, this entire ecosystem of crypto or digital assets, all of them are priced in US dollars, right? I mean, there are, of course, the ETH, Bitcoin, you know, there are charts where you can look at the Bitcoin price of something to see, you know, how it's doing relative to Bitcoin. But if you go to, you know, Coin Market Cap or CoinGecko or, you know, DeFi llama or wherever, wherever you're at, you're looking at market cap in dollar terms. You're looking at the price of these different assets in dollar terms. And it's so clearly the main unit of account all throughout this space is US dollars. And if you go to Europe, it's euros. If you go to China, it's it's the yuan or whatever. So yeah, this notion that crypto has become a unit of account, that's just straight false.
So
We know that's not true.
And we're going to mention one other thing that's a huge part to this narrative of what is money, because as mentioned at the beginning of the video, look, this is our nerdy passion. We've actually been reading history books on the dynamic reality and changes of money as an institution and what it's come from. And so it's really fun for us to be able to kind of talk about how it fits or doesn't fit into this new narrative with ease, because we've been following this kind of information for many years. And another aspect of money when it comes to this is not just a store of value and a unit of account. Pardon me, I lost my train of thought. So
well, I'll fill it in because I kind of think I know where you're going. It is we've had various monetary
legal
regimes.
Tender. Pardon me.
Okay, well, they're going to legal tender. Gotcha.
I was going to legal tender. I was saying that that's where I was going. We do finish each other's sentences often when it comes to this stuff. So let me just go that we all know that gold has value, silver has value, and at one point they were money, but gold has been demonetized. People buy gold, people may exchange gold. There are places that sell gold, but they sell it all, like you said, accounted in dollar terms, and dollars are what is money. Gold is not money. Silver is not money. And they're more stable. Arguably, they're a lot more stable than Bitcoin or digital assets. So the idea that that
checking
Bitcoin,
one or two of these boxes gives you to money is not enough. It needs to be all, right? And not just a store of value, but it also needs to be a unit of account and a widely accepted medium of exchange. And gold and silver check more of those boxes than digital assets do.
Absolutely. So that's just the money for it. And now if you're an attorney and you're representing a blockchain project or a layer, pretty much any layer one for that matter, it's important to know that many places never received an investment of money in order to start their project. Right. And this isn't a bad thing. This is actually one of the neat features of this new technology, is that it's niche, it's small, it's emerging, and it hasn't really taken that much out of the mainstream economy. There's been a lot of internal value created and developed and spread around, moved around within the Web3 digital economy to incentivize production, to naturally incentivize development in this new ecosystem. But you'll even find, I think that with Ethereum and most ICOs, I believe that they were not asking for people to donate money like no, your debit card, credit. It was Bitcoin. And the reality is that if you start looking at all these blockchain projects getting their birth from Bitcoin as the seed, and Bitcoin isn't money, it's just this new digital value token that allows for other digital value tokens to be to emerge and to kind of be judged against that Bitcoin standard, which is what started it all, right? It's transaction time, its ability to process that many, and people say, well, we need something faster. Oh, we need something that can perform smart contracts. So Bitcoin created and still holds a foundation and a standard for security and blockchain operations, but it's never been money. So many projects, if you look at the whole of projects that started with investment in Bitcoin or Algorand, say, give us your Algorand, give us your Ethereum, give us your Avalanche, they're not asking for money. They're asking for digital game tokens in this new emerging economy, who are, everyone knows is that Algorand's not money, or that any of these aren't money, and that they're too volatile. So that's
to
the
serve
money
as
side.
that function. Well, there's one more thing before we walk off from that, because there's one more point that I think needs to be made, and it's not narrowly economic. It's getting into the political sphere, but I think it's still relevant. You mentioned that we've had previous monetary regimes that gold and silver was demonetized You could, and that's the 33 FDR period. You could look to Nixon and then 71 when the gold window was closed. And in both those major changes in the rules of money, you could say, both of those instances involved executive actions that were later codified by congressional oversight and passed through a legislative interaction, right? So it wasn't just a single branch of government making this decision unilaterally, right? In this case, it's not even an executive order. We're looking at just Gary Gensler, the SEC chairman, right? But so my point is that it should never be up to one person to decide something so big and important and as what is the definition of money. And if we are going to include digital assets under that umbrella, I do think, in keeping with the democratic norms of Republican democracy, and that it should be something that's done through the congressional legislative process, and not something that somebody just arbitrarily makes law through their individual unilateral whim.
That's a great point. You're right. That needs to be made before we move on. Never before in history has just a random official that happens to be a bureaucrat that happens to be in charge of the SEC or CFTC or anywhere have they been able to write a paper that subversively creates through definitions a new money, when money is something that we go off of legal tender at the moment. Legal tender is money. It has been for quite some time. And like you said, that came through our current, Federal Reserve system. These were done through acts of Congress, and there's a lot more goes into this decision than just a Howey Test perspective from a serving SEC chairman. So does he have the authority? Does Gary Gensler have the power just by suing people through the SEC? And I guess attorneys should be asking judges this wherever around the world. How is it that the SEC chairman can just determine all of a sudden that digital assets are money when they, in many ways, don't pass the money standard?
One more thing.
Legal tender.
One more thing to add to that. If he does have the power to do that, and they do become money, does that not threaten what we call monetary sovereignty, with the ability of a nation to control its monetary policy? Because if there are these money assets that are cross-border, based in distribution, based in code, where the inflation is at a certain rate, that's taking a lot of the monetary discretion out of the hands of the central bank, putting it into the hands of cryptocurrency enthusiasts. And I don't know that the Fed or the Treasury or would be on board with that, because monetary sovereignty is kind of important to this whole thing working.
Right.
So,
and now
that's it.
That being said, it's easy to have a digital asset, a new property, a new area of the economy emerge that has value. You're not saying that the market, that the ability, that this technology that allows people to exchange value borderless, that this is a great technology and has shown already to have many uses. But to declare any one of these or a group of these as legal tender, as money, takes away a lot of the policy power and that we're used to seeing in modern banking system. Not
that we automatically oppose that, but it needs to be done in a thoughtful way, right? It doesn't need to be the whim of one person, right? It needs to be integrated, studied, voted on, and done in a rational way.
But that being said, obviously, when we do come to that way, hopefully money is still something that can serve as a store of value and isn't highly volatile. I mean, the reality is digital assets, blockchain, crypto, not one of them could count as money in and of themselves. So do you want to get to the next of the three main tenets when it comes in common enterprise? Should we talk about common enterprise?
Let's do that. You've done some good research on this, so I'll let you take the reins if you want.
Incidentally, I did, and I didn't plan to. Oh, it's right here. Or it's this tab. And this is, of course, we're going to leave all links below. This is education. But again, just like we're using the SEC's website and the SEC's definitions for digital assets under the Howey test, it's important to understand the law and understand common enterprise, understand the Howey test and its applications in the past throughout the throughout the markets before blockchain. And we'll just, there's a few key points. We'll start here with the introduction, but the Howey test, as many people may have heard, is a 3-part test to define an investment contract. An investment of money, which we just talked about, in a common enterprise with profits depending solely upon the efforts of a third party. And this is very important to understand: profits dependent solely upon the efforts of a third party, and also what it means to be a common enterprise, because you'll find that not only do digital assets, cryptocurrencies, fail the money test, but they also fail the common enterprise and also the profits dependent upon a third party test. So let's get into it, exactly how, and these links will be below so you can read and share this as well as the video yourself. Now this paper is specifically focusing on the commonality, horizontal commonality, the common interest.
Let's break that up. Oh, what the different?
Enterprise.
So there's 2 different kinds of commonality that you'll see the SEC talk about. There's vertical commonality, and then there's horizontal commonality. And just to give you a quick definition, horizontal commonality, that's the commonality between the investors, and it requires them to pool assets, and it also requires them to receive a profit distribution from the firm or the company. And the other kind of commonality, vertical commonality, this is a relationship between the promoter and the body of investors. So it's vertical. You've got the organizational, promoter at the top, and then below that you have the investors, and the relationship between the two is this vertical commonality.
Okay, so moving on, to meet the countless and variable schemes devised by those who seek use of money of others on the promise of profits. So the idea is that
that's
if
a security.
That's a security, correct. And of course, if digital assets fail the money test, then what we're really talking about is a new, highly risky, volatile arena where internally digital assets have been created to allow for the incentivization of development and growth. But the idea that anyone seeking Algorand or Bitcoin or Ethereum is seeking money is not the same thing. So it's very important to understand, again, the difference between digital assets and money. And we're going to get into the promise of profits. So
well, let's do the commonality first, because that's the first standard. So there was a case dealing with some commodities, a commodity brokerage account, right? And the I can look it up right here. First paragraph. We go. You go ahead. You found it? Oh yeah, that's it right there. Yeah, I was looking at the notes. Yeah.
I've got my notes there that I don't have in front of me. I know that there's this one right here, the third paragraph. So here's another example. Okay. The Supreme Court in Cherepin versus Knight recognized the common enterprise element of the Howey test. The plaintiffs were a number of individuals who held withdrawable shares in an Illinois corporation. The plaintiffs would only receive a return on their investments if the corporation made a profit. No interest rate was set on the investment, and the return was based solely upon the success of the corporation. In Cherepin, the court held that the plaintiff's participation in a money lending operation satisfied the element of common enterprise because their profits were dependent upon the management of the money lending operation. So before we move forward, why is it important to understand the difference? Well, when someone buys Ethereum or buys purchases on some, however way they do it, they're not actually giving money to Vitalik Buterin. They're not giving money to anyone at the Algorand Foundation. You're not buying shares. See, in this example, what they're specifically doing is they're buying shares of a corporation, and that corporation is using that money in order to create profits. And virtually nowhere when it comes to at least layer one smart, blockchain technology, do you have the natural supply and demand price effect, purchasing of a digital asset equate to sending money to the head of a foundation in order for them to create something of value to generate profits. And of course, we know in reality, just to give an example, the economic reality of blockchain, which is the point of this, how does it compare? Most of the value that's built on a public blockchain, whether it's Bitcoin or Ethereum, it's not from Vitalik or Satoshi Nakamoto. It's from other developers that have access to build and create something of that other people value to use that network. So it's actually the public, the active participants, the investor class themselves are the exact same class responsible for adding value to their own investments. You're not actually giving up to a third party. So there's that aspect of it. But when you go further, it gets even more detailed. The circuit courts disagree regarding the proper test for determining whether a common enterprise exists. This gets very interesting. And now this is where they get into how the certain courts have adopted a very narrow horizontal commonality test. Under this narrow test, there must be multiple investors and pooling of funds. Now, it gets very interesting when you look at the examples. Let me find vertical.
Yeah, you're getting close to what I was bringing up. That Curran versus
here it is, the Merrill Lynch case.
Merrill Lynch. Yeah.
Here we go. Here, this is the one. Okay, so in the horizontal commonality, there is a previous case. Let's go right to that one you were just talking about. The common enterprise issue has surfaced in many cases involving commodity trading accounts. What's great about this commodity trading accounts is many people are calling digital assets a commodity of a sort. Whatever, I'm not going to get into that, whether it fits this, or if we should create a new digital asset class that makes more sense. But these are people who had individual commodity accounts. Now, as you know, when it comes to public blockchains or blockchain technology, people who have a Web3 wallet or are staking are a lot more decentralized or a lot more separate than individuals with brokerage accounts at Merrill Lynch. But what was found, the court held that a commodity account did not meet the common enterprise element of the Howey test, did not. The court strictly construed the Howey definition and held that the investment was not part of a pooled group of funds and thus does not meet the second part of the Howey test. Well, there you go. I mean, when it comes to that definition, virtually all layer ones, virtually most digital asset, most projects out there you would find are not a pooled group of funds from investors and therefore would not meet the Howey test.
Right.
But
yeah,
I think,
and one thing I would add that kind of goes to support their reasoning is that those commodity accounts while those funds may be pooled in a brokerage account somewhere, those accounts are still separate, and each investor has claim on that, whatever that sum is. And those investors aren't pooling their assets to be used together. They're actually often trading in a game theoretic, way with each other, trying to buy low and sell high, and it's a zero sum thing, right? If you make a profit on a trade, someone else had to lose. So the commonality, it's actually an inverse commonality. There's I don't even know what word to use, but these accounts if the commodity brokerage, like you said, was not enough to meet commonality, then certainly a self-hosted wallet that your keys, your coins, you're not giving up custody of them. How does that, if the other didn't meet it, then that is one step removed even from that, because you're never
absolutely
even pooling. You don't even have surface pooling going on. You know what I mean?
Absolutely. Absolutely. I mean, blockchain technology is more decentralized than individuals having a brokerage account with the same company. And if individuals having a brokerage account with the same company don't pass muster, how would it pass muster individuals on a public blockchain that have different interests and who aren't dependent upon the profits of a third party, which we'll get into on the last tenet. But we've
That's pretty
obliterated
much the first two.
obliterate the first two. Now, like we said, Gary Gensler has often come out and said that there's a lot of clarity on the subject matter, and people have charged him in the past with not being clear. And to his credit, when we look at the Howey test, and we'll go back to the security sec.gov website on their Howey test applied to digital assets, but you'll find that they are extremely clear on the charges. And because of this clarity, it really does open the door for some positive growth in this new ecosystem, while still giving them the opportunity to look into those projects that may be preying upon people with the promise of profits and pooling funds together,
Right.
which is the whole purpose of the SEC, which would be great to protect people from that.
Exactly.
Kern also involved in investment in a discretionary commodity trading account. The court acknowledged the debate between horizontal and vertical commonality. Not surprisingly, the plaintiffs asserted that the common enterprise element was met by a one-on-one vertical relationship between the promoter and the investor. The court rejected this vertical approach adopted by the Fifth Circuit and instead adopted the more restrictive horizontal approach. The court held that the common enterprise element of Howey can only be met when there also exists between discretionary account customers themselves some relationship which ties the fortunes of each investor to the success of the overall venture. And that's what you were just talking about. When you actually go into these ecosystems, all Ethereum holders aren't equal, whether you're staking it, whether you're holding it, whether you're using it to build or using it to sign contracts. The idea that everyone is pooled together to the excess of the overall venture is not an accurate description.
Yeah, even considering to put a finer point on that, there's people holding inverse ETH that are, literally bets that ETH will fall. So
on the Ethereum blockchain.
On the Ethereum blockchain. Yeah. So I mean, the idea that their fortunes are tied together, I mean, well, in a very loose sense. But it's a positive sum, or it's a zero sum kind of thing.
I feel like was there one more note page that I had? Let me see on that, or is that pretty much it? 127, 120. No, that was it. That was it. We pretty much covered.
Yeah. Commonality. We got that covered.
We got that covered. So we'll leave that. And the idea is that, of course, if you're a lawyer, if you're working for a blockchain project, this is something hopefully that could be, or for lawmakers that are looking to help pass healthy regulation and promote technological process and growth in the market, this can be very helpful, I hope. And this isn't it. We've also got the third tenet, which I think we've touched on with the common enterprise.
Yes. But there's some gems to get into.
There are some absolute gems. And why don't you start off getting into that?
All right. So this third leg of the test is going to have two parts. The first part is reasonable expectation of profits. And then the second part deals with relying on the effort of others. One definitional convention to keep in mind here is the SEC refers to AP a lot in this section. That's dealing with the active participant. You kind of think of that as like the entrepreneur or the the leader of the project. So what they're looking at here is how much is the active participant or the leader how much are they providing managerial services that are keeping the enterprise afloat and ongoing, and how much do investors expect to derive profits from those kinds of efforts? And if there's a significant managerial effort, and if people expect to be profiting from it, that's going to be that's going to, you know, engage the Howey test. That's going to fail the Howey test and make something or render something into a security.
Can I say
Before
something
we,
real quick?
yeah, go ahead. Sure, sure.
Just on the expectation of profits, one thing that's important to remember is when the SEC throughout history and markets are determining whether or not people have profits, even when it comes to the original Howey test and the land and the oranges being sold and then the profits being distributed, what's always been distributed is money, legal tender. And what you don't have on any of these well, I say any, I don't know, but I'm sure there might be something out there. But for the most part, whether you might have a distribution of Algorand or a distribution of Avalanche or a distribution of Ethereum from some project that you may be able to use for different blockchain projects. But the idea that you get some type of distribution of money is not real. And we've already been over the economic reality, the fact
Of why.
that digital assets don't serve as money. So if I'm gonna,
Right.
if I promise to pay you in game tokens for a game that I made that other people value and play, and you agree to that, that's fine. But I'm not paying you in money.
In
That's
money.
different.
It's
You've
yeah,
agreed to get paid in some new volatile game token. So
right. Well,
reasonable
let's
expectations of
touch on,
profits. I was going to mention
right.
one more thing.
Go ahead.
When it comes to virtually every proof of stake network or staking system that has a consensus mechanism of distributing a token over time, those are never considered profits. It's never been a reasonable expectation of profits for any blockchain that if Avalanche inflates at X% and you stake some Avalanche, that you will receive X% for securing the network. Those are not considered profits. That's considered inflation, which is, ceteris paribus, the value would be
Dilutes.
going diluted over time. That's actually what's promised to people who enter into blockchain. They take such a high risk that they know they're going against the natural dilution to secure the network, but there's hope that despite that dilution, that the value due to supply and demand factors will make that negligible and worth providing support to the network. And I say that because Gary Gensler actually in the SEC actually leaves space specifically
For that.
to separate. He says, do not confuse price appreciation of supply and demand with profits. So as the SEC says on their own website and through their own perspective.
We're going to get into that. We're going to get into that point too, because that's one of the gems. But before we do, I think there's something that caught both of our eyes in this section. There's a subscript 12. You'll see the 12 right there. If you click on that, you'll find that there is a little reference to a court case, and one of the takeaways that's kind of that they're drawing your attention here to this.
It's actually a court case that we just got. It's actually the court case that we just got through going over. So you understand,
right?
This is right to the heart of the Howey test.
For sure. And I think the principle that's going to be elucidated is useful in a lot of ways, in a lot of places beyond just what they're doing here. So in this court case, they were looking for the meaning and the scope of the word security in the acts that establish these laws, and what they decided is that the form should be disregarded for substance, and the emphasis should be on economic reality. So form is trumped by reality, which means that naming conventions, the way things appear, is not as important as what's actually happening at a fundamental level of economic transactions or way people perceive things, right?
I'm going to interrupt you real quick.
Yeah, go ahead.
To add to what you're saying, let you and throw it back to you. In other words, just because we call things digital currencies doesn't mean that we're actually trading in money and currency. Digital currency is just a form. It's not the economic reality. It's a word we call it because it's the easiest way to express being able to exchange something of value in the digital world. So let's just call it a digital currency, but that doesn't mean that it actually is currency, is serving as money, has ever been designed to be currency or money. And that's where we're getting into over the economic reality of blockchain crypto versus the form.
Right. Exactly. And this is this insight is being focused on whether or not something is a security. It's saying, ignore the form, focus on the reality. And if we take that same approach to money, we ignore what you just said, the form that cryptocurrencies come in, and we just see that they aren't really currencies, they aren't really money. So this principle that it's really powerful, and I think it should be, it should not just be used in the narrow application, but this should kind of guide us as we think about these issues throughout the whole thing.
I dig it. That was a great point. Is there anything else under this reasonable? There's a couple, I'm sure, actually.
Yes, I've got a bunch of little bullet points I wanted to go through here. So
good.
When the SEC's this is all guidance on how to understand whether or not something is a security. In terms of the reliance of others, there's a few bullet points that kind of jump out. I'm not going to list every one of them. You can go and read this yourself. We'll have links below. But some of the big things that jump out at you, and so we're talking about reliance on the effort of others and profit from the effort of others. That's the subject here. And so what they look at is, does the purchaser reasonably expect to rely on the efforts of an active participant, like a leader or an entrepreneur or a manager, right? And are those efforts undeniably significant, essential, managerial efforts, which affect the failure or success of the enterprise, as opposed to efforts which are more ministerial or less important, right? The next thing they look at is the network or the digital asset still in development? Or is it fully functional at the time of the sale? And can purchasers, do they expect the AP to further develop the functionality or not? Next, we look at, are the essential tasks or responsibilities performed and expected to be performed by the active participant, or are they performed by an unaffiliated, dispersed network or community of network users known as a decentralized network? So that's a big one. Who's carrying out these essential tasks, and are they affiliated or unaffiliated with the project? Moving on, we're going to see if the active participant has a lead or central role in the direction of the ongoing development of the network or asset, and in particular, if the AP plays a role in deciding governance issues, code updates, or how third parties participate in the validation of transactions that occur with respect to the digital asset. So we're looking at how much control and management is at work here, and how much of it is a decentralized community of users that are handling these things, right? So the more decentralized something is, the less likely it will be a security. And so we're talking about issuance, buybacks, token burns, things these are decisions that really have an impact on supply and therefore price, right? And so these kind of huge managerial actions, the more you see of that, the more likely the project's going to fall into that securities bucket.
I'd like to jump in real quick while you mention that, and let's go through these points and explain not just what they are, but whether or not it passes muster. I would say, does the purchaser reasonably expect to rely on the efforts of an active participant? One thing to note about blockchain and crypto, that many of the projects, is that the purchaser and the active participant are often the same person. The idea that these are two parties dependent upon the efforts of others is not true. The reality is that anyone who's interested in using, they believe that Ethereum or Algorand or Avalanche or whatever, name the chain, Cardano, has a value and they want to build on it, then anyone can access that code, hex or something else, and build on it, right? So the idea that you're expecting to rely on the efforts to increase value in your network isn't necessarily so. And just because a Vitalik or someone who may have a portion of tokens that gives them a vested interest in seeing it develop as well, isn't the same thing as having a corporation receiving funds and receiving money who is in charge of adding value to the network. Because in reality, when people acquire more of a digital asset, they aren't really sending any money to a third party and hoping that they will build out new infrastructure. And the reality is just a price appreciation from supply and demand, that if someone is a holder and has access to those digital assets, then they'll have more value there with which they can use and have access to, right?
Right.
But is it reasonable to expect on others for increasing value of the network of a public blockchain or of a third party foundation?
Yep. And then further on, they're looking at kind of the nature of, because there's oftentimes these foundations get projects, they launch them and they're completed, right? But then there's other times where you hear of like it's a roadmap and there's lots of development going on, and we have, we're this quarter, this is going to be launched, and we're working on that for next quarter. And so one of the takeaways here is that it kind of depends on how complete the project is and how much the active participant is being counted on to produce that value in the future, or if it's already a completed thing that functions in the here and now, right? I think that one of the takeaways here is that that's a big determination of.
And I think mentioning that, I think many projects can be complete and still be in progress. In other words, projects can be built and complete and functioning so that you can use it, so that you can sign transactions, you can build contracts, but they also may still be developing to have improvement. Bitcoin is considered to be complete, and yet you still have applications, networks being built to make it more robust and to make it easier for adoption and more use. So the idea that changes or developments are happening does not preclude a blockchain from being structurally fundamentally complete and ready for market, so to speak.
And
are there any other
things that,
go ahead?
I was gonna say, one of the things that kind of shifts that one way or the other would be, who's doing the development. Is it something that's only done through the foundation, or is it this community driven thing where people are launching new, layer twos, and so clearly it's not a matter of one company that's in charge of all the blockchain, all Bitcoin development or all Ethereum development. There's an ecosystem, an unaffiliated network or community of network users that is performing these actions. Many of them are managerial to the extent that they have very large influence on all parts of this, but the key is that they're not affiliated, right? This is an unaffiliated network. So to put it in the same basket with, say, what an Exxon or a Conoco is doing with their investments, it's really just, it's kind of disingenuous.
It's a lot of what we're seeing is that trying to apply securities laws to blockchain digital assets is the old, trying to force a square peg into a round hole. It's just not.
Yeah.
They're not the same. And I was going to mention something else about that. Right. The expectation of profits from the efforts of others. So something fundamentally to understand is that, like you just mentioned, when someone purchases a digital asset, do they expect to have profits distributed to them from, let's just say, Ethereum, for example? It's the biggest one. Let's just use that as an example. When someone purchases Ethereum, are they expecting to receive profits from anyone managing Ethereum based upon the success of Ethereum? In other words, if Vitalik or someone else creates a protocol that they make a lot of money from, do I expect as an Ethereum holder to be receiving some distribution of profits of Ethereum? And the answer is no. No one who purchases Avalanche, Algorand, Cardano, Ethereum, none of these decentralized blockchain networks operate to where if the foundation who of course they have an interest in increasing value, but they're not managing the profits of other people. If they create something extremely profitable or extremely valuable, do I expect that they're going to distribute a share,
No.
a pro rata share, which is what the SEC law says, that
Right.
there needs to be a pro rata distribution. So the reality is that on so many fundamental levels, do digital assets fail to meet the definition of a security, that we're really excited to share this information because I mean, clearly, but most people are just reporting the news and talking about and waiting, and we're hoping that we can get this information out there to help with the process and to
Yep.
promote you know, a healthier environment for progress, for blockchain to flourish. And
Yeah. You know, before we I don't want to cut you off, but I think there's one more thing we should touch on when it comes to reasonable expectations of profits. And this is in this SEC thing as well. So one of the things they look at is there's different ways profits can come about, right? You can have capital appreciation, which results from the development of the initial investment or the business. And then there's a participation in earnings resulting from those funds that have been invested. But then there's also, so that's sort of like profits that come from pooling money together and doing something with it, right? And then splitting up and distributing the profits based on how much people invested. So it's like a pro rata distribution. And then there's profits or what we call price appreciation, which results solely from external market forces, such as a general inflationary trend or some change in the economy. And this price appreciation is from supply and demand changing, and not because of something that the business did necessarily on its own inside. So it's an external effect coming from the market as a whole, whether it's a change in taste or a change in supply shocks, or maybe an inflationary trend that's going throughout the economy. Like, so these kinds of macro forces are not considered profit under the Howey test. So the price appreciation, yeah, that's huge.
Because most people, they assume they're guilty of failing the Howey test because they assume they've profited because, well, I got Ethereum, it was worth $300, and now Ethereum is worth $1,500, so I guess I've profited. But what they're not understanding is that, no, you just happen to benefit from the temporary price appreciation resulting from external market forces. And that's actually what underpins the value of digital assets across the board. It's actually supply and demand factors. So that for people to think that they are profiting under the same terms as the Howey test, that's another reason why we mentioned that. And
right.
We're really excited about this because having followed blockchain crypto for quite some time and having a research education channel where we experiment trying to understand this new emerging technology and which way it's going to go, I feel that this information, share it or regurgitate it and make it cleaner and better. But I do feel that this information can help the economy, the market, and people over the world, because bad laws will affect, in this new decentralized technology, really misguided laws can have a drastic impact, not just on people here, but over the world. And ironically enough, blockchain and crypto was designed to kind of even out the playing field and give people everywhere around the world, middle class, economically speaking, on the lower spectrum, versus people in the top percent fields with access to wealth. It's supposed to kind of level the playing field and allow for an arena where people can take risks to create and build value. And I think that if we can allow regulation of this new market to promote that, then it would be better for the economy in general. People here, people there, everywhere.
Yeah, for sure.
Hopefully, for the people listening and watching this, you can drop a comment below. And did you want to mention?
Yeah, there's a couple more things we could talk about.
Cool.
wrap it up real fast. We kind of touched on the big parts of it, but there's some other considerations that at the very end of it, the SEC's kind of given us such a bunch
Some
of hints,
outs.
kind of, I guess, some outs. Yeah.
Yeah.
The first group is talking about the things that make it more likely that there's a reasonable expectation of profit. So let's make sure you're looking at what I'm looking at. But so I'm looking at a few things that if these are present, it's more likely that this is a security, right? And there's a few bullet points. The first is that the digital asset gives the holder rights to share in the enterprise's income or profits. We kind of talked about that, owning something that goes up in value is different than having the right to share in a pro rata distribution of income from a company, right?
Right.
Very different things, right? So, but if that is the case, then that's a real good indication that you've got a security. The next thing they look at is the digital asset transferable or traded on or through a secondary market or platform, or is expected to be in the future? So this would be, any kind of, resale market, any kind of swap or a place where it could be exchanged, traded and transferable. And we're going to explain kind of why they're focusing on that in this moment right now, actually. So the secondary market is would be useful for buying and selling, right? So that they look at that as speculation. And the kind of the dichotomy that they're working off of here is that a digital asset can have it can come in many forms, but they like the form that it's used to buy things, to buy goods and services inside the network, right? So imagine a website where they like a overstock.com, take it for an example. What if they had their own token you could buy, and then you could use that in the website to buy furniture with, right? And they could have incentives to kind of, keep you in that world with that token, and that would pass muster. But what if there's a secondary market where you can transfer their O token and then sell it? That now we're starting to look at things the SEC says is the more of these that are likely, the less likely it's not a security. So this transferability through platforms to secondary markets is it's something they're looking at, to say, just to make that clear. Another thing they look at, which is closely related, is they look to see if the digital asset is offered and purchased in quantities that indicates it's being used on the network versus quantities that indicate it's being used just for speculation. And they also say the same thing about the price, that the price of the digital asset should be connected to the price of the service or the goods that it's buying, and not wildly disconnected. So these things basically turn on a theme, and it's that the token is useful, has direct utility, and it's not something that's purely a speculative tool. Any thoughts?
Well, yes, if you have a Web3 wallet and you understand how blockchain works, the reality is that it is utility based. It's not investment based. So while you may be speculating on the supply and demand price appreciation, which is what it is, the fact of the matter is that when you hold Ethereum, or when you hold name token or project more often, especially layer one smart contract platform, you hold the ability to sign contracts. You have a token of utility that allows you to engage with platforms, the decentralized applications on that chain. And if you want to use a messaging service like Alter on Secret Network, then you're going to need to not have Ethereum. You're going to have Alter. Now, in the world of money, you can use money for everything. If you've got money, you can buy this. If you got money, you can buy that. But if you want to work on the Ethereum network, you're going to have Ethereum for fuel. It's the gasoline.
Yeah.
It's the fuel that allows people to travel down the Ethereum highway and to build ecosystems. If you want to build an ecosystem, it's going to cost you ETH. If you want to travel and use the ecosystem, it's going to cost you ETH. So while you may have BlackRocks and MicroStrategies or whoever come in and buy large amounts, I think really what the SEC should be focusing on are these large financial intermediaries and maybe their relationship to their retail clients.
Yeah,
but to declare that that blockchain itself is now a security, and that anyone who has access to it is now engaged in securities trading or selling is ridiculous, is absurd, is ridiculous. And
Yeah, I
not for
agree.
this video, but laws passed to hamper self-custody and force people into large conglomerate corporate intermediaries for storage of digital assets is counterproductive to the whole testing, the whole emergence, the value
Discovery.
proposition, the discovery of blockchain and crypto, allowing this emerging with internally incentivized ecosystem for people to pop in and out all over the world to build something, let it fail, build something, let it work, build something better, has done wonders. Look at Ticketmaster corporations already using NFTs, the Goldman Sachs in Hong Kong. The reality is that if we would like, as a population, humanity, people, to see what people are going to be able to do and create, let's not cut off the flow of resources or the energy, the desire to allow people to build. When it comes to nefarious act, we got more content, more videos to do on these nuances, but the reality is that blockchain and cryptocurrency is the best technology at being able to limit nefarious actors, because in this new world of blockchain technology and public blockchains, you're able to monitor transactions and from where and on so many details than ever before people have ever thought of before, cash and gold and silver. That in many ways the technology itself catches more criminals. You actually don't need to pass draconian laws to monitor everyone with a wallet, because having a wallet and operating on the chain is public. you're gonna get monitored. So
well, here's the last little section we can close out. This is going to be a list of characteristics that make it less likely that the Howey test is going to be met. And we kind of touched on this earlier, but the distributed network or digital asset are fully developed and operational. That's a big one.
And by the way,
holders of the digital,
to that point, I just want to, as we cover this point, I brought up Hex a couple of times only because we've mentioned in previous videos, and it has a we'll talk about the idea of time value, locking something up for time. We did a whole conversation on the innovation that poses. And of course, this again goes to, it's inflationary. It's not a promise of any profits. And I believe I heard post our video that the founder is reworking his definition. Instead of it being about interest rates and return rates of profits, it's actually more a feature of valuing, creating a value for time on blockchain, which is beautiful. But I mention this because you can have a token like Hex that's completely operational, or name another token that's complete. You can have a blockchain that's completely operational, fully developed. That doesn't mean that you can't build Pulse Chain, or you can't build something upgrades on top of Ethereum. My point is that there are many projects that have people with incentives to make it better and to add more of it. Wise Token, Peter Gur. I mean, you can have complete projects that at the foundation, they're up and running, and if people value them and want to use them, then they can build on top of them, like I said, layers. But that it doesn't mean that something has to cease having any development on it whatsoever in order to be fully developed and operational.
Well, it definitely shouldn't be. Shouldn't mean that. No.
Yeah.
A few other characteristics. You're able to immediately use it for its intended functionality. The prospects for appreciation of the digital asset are limited. If the asset is called a virtual currency, it needs to be able to be immediately used to make payments on a wide variety of contexts. So it looks like we don't have a virtual currency yet. Further, the digital asset is marketed in a way that emphasizes its functionality and utility rather than its potential for increase or speculative gains. And then there's more. There's a few other things that it goes on and on, but it talks about if the active participant facilitates the creation of a secondary market, then the transfers of that asset may only be made and among users of the platform. So that sounds like it lets AMMs and DEXs off the hook, because those swaps do happen because of it's by and among the users of the platform. It's not it's typically not a centralized thing. It's, there's users that have that have invested in a liquidity pool, and they've added those funds to those pools, and those pools that self bootstrapped liquidity is how those swaps is the fund that makes those swaps possible. And so it's by and among the users themselves. Yeah, so it feels like that's a good, I mean, I'm not a lawyer, but that sounds good to me. There's a few other characteristics that will make it less likely that the Howey test is met. A lot of them do turn on the price and its connection to the utility, and how much it is, and how much speculation is involved, right?
Absolutely. And you read these points and you'll find, of course, if it meets these points, it's not considered to be part of the Howey test. And right. You read through some of these and you're like, hey, that reminds me of a crypto project I'm familiar with, or that sounds like blockchain general. So, this is, to sum it up, the three main points: whether it is an investment of money, or a common enterprise, or a reasonable expectation of profits, which I would say there probably aren't reasonable expectations if you're coming into an ecosystem. It's funny that he would talk about this ecosystem having a reasonable expectation of profits, when coming from the mainstream market world, they've talked about crypto and blockchain as being too volatile, too risky. You have
worthless.
Elizabeth Warren calling it air and having no value. And
right.
of course, air is extremely valuable. We'll talk about the diamond water air paradox.
Well, it's funny. It's because
go
crypto
underwater, and all of a sudden air.
You could almost say that crypto's status is almost like it's everything and nothing at all. So I mean, if you listen to some people, it's worthless. It's purely fraud, right? Or it has no intrinsic value. Others will tell you it's a security. And then out the other sides of their mouth, they'll say it's also money. And then a whole other group of people will call it a commodity. And then you got some people like, Saylor over there, who's like, it's universal property, and good luck defining that.
Which is a whole new, legal term.
Right. So, yeah, I mean, if you're not confused, then you're not paying attention.
And that's a good point. And hopefully our goal is to help relieve confusion as we research more, so that we can come to a better understanding. Hope to be able to share that better understanding so that it can add value to the conversation and to the system, as we're all a part of this new emerging technology. It's very exciting. We're all a part of this new technology that's coming up and changing the scope of communication, changing transactions and value exchanges, and so many more things in the world. So if you enjoy this, hit the like button, subscribe. Obviously, this is educational, not financial advice. We don't give financial advice ever on this channel. It's purely research and education. And if you would like to be the first person to support our educational efforts, then we've got some donation links below. And we appreciate any support. If you feel that we're adding value to your blockchain project, feel free to share that. Don't forget to tip your waiter and help us keep these cameras and lights going. But we do look seriously. We have some more content that we would like to be able to cover. And some of those topics would be, let's give some spoilers. There are the CBDCs and stablecoin.
That's right. There's an article, or a study rather, that we're going to talk about CBDCs and stablecoins and the banking system, and the links between, and what risks might be there. So we're going to go through that. We also have an article on we had an article on securities that we just covered. And what was the next one we were going to do?
We have, does Bitcoin and blockchain make the banking system obsolete? That's been a topic recently. Many people believe that we're in this dichotomy of the banking system versus Bitcoin and blockchain. And we've got a great perspective, I feel, to add value and to share, that maybe it doesn't have to be this either or. Maybe it's more realistic that blockchain and Bitcoin would be a part of this new system and not so antagonistic. So we've got that narrative. Are stablecoins a threat to CBDCs? We've got the Restrict Act and the idea of censorship in the new digital economy. Are public blockchains dangerous? In other words, is censorship necessary with blockchain technology for safety and security? Or do you find that public blockchains allow for so much more transparency that we don't need the extra oversight than we currently have, that the systems we have are plenty enough already?
Scale it back a little bit. Yeah,
absolutely. And is anti-crypto anti-American and pro-large corporation? Because there's a talk right now about anti-crypto movement in politics under the guise of protecting retail, when we peel behind the curtain and take a closer look, maybe we'll find that blockchain and crypto itself is this new market that it stands not to replace or take down the banking system, but at force growth and force it to change with the new economy, and allow opportunities to disenfranchise groups that may not have had those opportunities in the previous monetary system. So
very cool.
Those are some exciting topics. If you want to be a part of that, you know what to do. Hit the notification bell. And again, we were really excited to share this information with you. It's exciting stuff. Economics, money and banking and blockchain. If that's not exciting to you, I don't know what is. And if it is exciting to you, then, stay tuned for our next content. And until the next time, have a beautiful day and namaste, y'all.